A divergence is one of the most effective ways to trade the financial markets. Divergence, as the name suggests, forms when the oscillator and the price action fail to converge. If you analyze price action in a chart, you'll notice that the price moves up and down, forming peaks and valleys. These are the expansions and contractions, or thrusts and retracements. For an experienced trader, trading based on price action alone might already be profitable. However, many other traders also prefer a secondary confirmation for their setups, so they use indicators. Some applied on price chart, while others are oscillating indicators on a different window on their platform, usually at the bottom of their main charts. Under normal conditions, price action and the oscillator tend to move in the same direction. When price makes a new high, the oscillator is also prone to make a new high. Likewise, when the price makes a new low, the oscillator is also prone to make a new low. When this converge fails, what you basically get is a divergence. A divergence is a leading indicator of price action. In other words, when you see a divergence, there is a high likelihood that price action will potentially make a reversal. There are many different types of divergences available. The divergences are categorized into regular and hidden divergences. While the regular divergence is easy to spot, hidden divergences are less rare and require some practice to spot them. Within the hidden divergence, you have the bullish and the bearish divergence. If you look closely at this chart, you'll notice how the MACD indicator moves up and down corresponding to price movements. However, if you'd also looked closely, you would also notice instances where the peaks and valleys height and depth would differ from that of the price chart. These are what we call divergences. It is basically a disagreement in the height or depth of the price charts and the indicators' peaks and valleys. This disagreement is telling me that even though the price chart has already formed a low that might not be that deep, mathematically, the indicator is showing that the retracement is already deep enough. This indicates that price is ready for a sharp reversal. This type of divergence is called a hidden divergence, which usually signifies a reversal of a short retracement, or better said, a continuation of an existing trend. So remember this, hidden divergences usually correspond with short-term retracements. How does the hidden bullish divergence work? A hidden bullish divergence works based on the concept of the lows in price and the lows in the oscillator. While a trade with divergences that are regular indicates a reversal of trending price action, hidden divergence is an indication that the trend will continue. I like to consider a hidden divergence as the end of a pullback. In order to identify a divergence, you basically need an oscillator. Any type of oscillator works in this case. The most commonly used oscillators are the Relative Strength Index, the Stochastic Oscillator, and the MACD. The Awesome Oscillator and the Money Flow Index are also great indicators to spot hidden divergences. In this example, you have the basic illustration of the hidden bullish divergence. In this chart you can see that the price makes a higher low compared to the initial low. However, RSI indicator makes a lower low relative to the previous low. This example shows another hidden bullish divergence using the stochastic indicator in a clear uptrend. As you can see, comparing the lows in the price and the lows in the oscillator, the hidden bullish divergence is formed. After the formation of the higher low in price then surges to a new high. It should be noted that the hidden bullish divergence can form anywhere in a trend. Typically though, the hidden bullish divergences are usually found in an uptrend. It forms close to the highs in the price action. A trade with hidden bullish divergence signals there is a strong probability of price continuing the uptrend. Also, pay close attention to the higher lows formed at the end of the pullback. Price action candlestick patterns can serve as great confirmation tools for the continued trend. The next type of trade with divergence is the hidden bearish divergence. In a bearish hidden divergence, the price makes lower highs, but the oscillator makes higher highs. This type of pattern occurs mainly during downtrend corrections. In this example, we see that while prices have continued to go lower and formed lower highs, the RSI oscillator made higher highs. This is what we call a hidden bearish divergence. Divergence theory tells us that there is a strong probability that the downtrend will continue. Basically, a hidden bearish divergence pattern means that the trend is continuing to the downside. And here's another hidden divergence, this time with the stochastic. Recent price action indicated a downward momentum, with the price making lower highs. However, despite the fact that the price was making lower highs, the stochastic recorded higher highs, thus forming a hidden divergence and signaling that bears were in a strong position to enter the market. Of the two types of divergence, regular and hidden, the hidden divergence represents the higher probability pattern. This is based on the fact that the hidden divergence is a trend continuation leading signal. Now that we identified the main types of hidden divergences, how do you trade them? The hidden bullish divergence method can be used in a number of ways. Due to the fact that the hidden bullish divergence is a leading indicator, it can potentially tell you what could happen next in price. Generally speaking, when a hidden bullish divergence is formed, you can take long positions, and when you spot a hidden bearish divergence, be prepared to search for short trades. The oscillators I used in the previous examples were the RSI, the stochastic, and the MACD. These are probably the most common oscillators for detecting divergences, but there are a substantial number of oscillators very useful to trade divergences. Now, from my experience, the most ideal place where a hidden bullish divergence can occur is at the end of a downtrend. Near the bottom end of the downtrend, a hidden bullish divergence can be a powerful trading signal. In this example, we have the hidden bullish divergence that is formed near the bottom end of the downtrend. If you closely observe, what you first see is a minor correction in price. This leads to a higher low in price. At the same time, the relative strength index indicator forms a lower low. This divergence then leads to an uptrend. One of the ways to trade the hidden bullish divergence is to wait for the RSI to cross its 50 level. Also, pay attention to candlestick formations. Pin bars and engulfing candles are great confirmation patterns that bulls are prepared to push price higher. Also, trendline breakouts and breakouts of a key resistance on a lower time frame are also very strong signals that the hidden divergence could prove to be successful. After the entry of the trade, the stops are placed at the higher low in price. Following this, aim for a 1-to-1 or a 1-to-2 risk-reward setup. As you can see in this example, the price action eventually reached our target. However, not all hidden bullish divergences are successful. You can find many examples of a failed hidden bullish divergence. The most common mistake that inexperienced traders make would be mistaking false hidden divergences scenarios as a green light to get started with trading. For instance, in this example, looking at the downtrend, you will spot that the hidden divergence starts much earlier than the official top. That's why when you spot the inception of a hidden divergence, don't enter the market blindly. You need confirmation from price action first and from the oscillator second. A hidden bullish divergence can fail when the price fails to make new highs. That's why you should constantly pay attention to price action. This example shows a failed hidden bullish divergence. Here, although price action jumped higher after posting the higher low, prices failed to maintain the gains. Sure, if you entered early at the stochastic crossover, this trade would have brought some profits. Following the swing high that is formed, price action barely tests this high and then drops off. This leads to a downside correction in price. As you can see, while this looks like a failed hidden bullish divergence, you can see that the failure of the swing high leads to prices posting a reversal to the downside. Price is king, that's why you need to let it guide you. So the big point to remember is that when the hidden bullish divergence forms near the top end of the rally, you can expect to see a topping pattern being formed. If the hidden divergence pattern fails, you can expect to see a reversal on the lower side. Here are other examples of successful hidden divergence patterns. The hidden divergence is an exceptional market tool that can pinpoint areas to enter the market and eliminate some of the guesswork created by false trading signals. Divergences, although not perfect, are very powerful techniques to use. Since hidden divergences usually occur on minor retracements, the probability of a successful trade is higher, since chances are you are still trading with a trend and not against it. If you learned something new and found value, leave us a like to show your support, and make sure you subscribe and click the bell icon to stay in touch when we upload new videos. Until next time.